Welcome, everybody. Thanks for joining us today, the Family Office Insights Luminary Series with my friend Landon. And this will be a first in two episodes that will have an opportunity to get to know Landon and what he's doing. Just a little housekeeping. We can't hear or see you, but we know you're there. So please feel free to post your questions in the Q&A or the chat box, and we'll get to as many as possible and just post them when they come to mind. And I'll keep an eye on it so we can get some engagement here if you have some questions that are interesting. Also, if there's anybody that you know that would be interested in what you hear today, you're certainly welcome to make sure that you connect with Landon directly for yourself or them. And you're welcome to do that. As I say, we're gonna post this to the Family Office Insights YouTube channel so you can revisit it or share it with others. And takes a day or so to do that. And again, we'll make sure that you have a way of connecting with Landon directly. So just thank you for being here today, everybody. And also just a little background. Landon and I knew each other because I've spent the past 3.5 years exiting New York City and traveling all over the place and put a stake in the ground out in Park City, Utah, and he's in Salt Lake. Technically, is it Salt Lake
Yeah.
in
Yeah.
in the hood? And so we've spent some time together and got to know each other. And he's got a really interesting group called Tribe Angels that I've been to, and I'm going to let him share some really interesting background of how he got to where he is today, because he's got some real deal flow chops. And so, with that, Landon, thank you for doing this. Take it away.
Yeah. Thanks, Arthur. And yeah, I've enjoyed having you around in some of our groups. We'll have our private event in Park City in April, so I'll have you come out to that as well.
Great.
But yeah, so some of the background on me, most recently, kind of the last 4.5 years, I I've been doing venture deals on a deal by deal basis. I kind of created a unique model in the space of venture because I'd worked for a VC fund before. I also had co-founded a company and gone through kind of the zero to Series A stage, leading the go-to-market. Ended up exiting as a co-founder breakup story there. But created my own model in the venture space where originally what I was doing deal by deal venture, and I was using SPVs. But unlike many of the people you talked out there, I would go to the entrepreneur and be proactive to find the entrepreneurs. And I would go find these entrepreneurs in these undercapitalized regions in the US. And I would say, find these companies that have great traction, great opportunities, and huge upside. And then I would go commit to work for them for free. And all I wanted was a right to invest in their deal. And then I would go help them think through crafting the story, um, starting to figure out who are the institutional VCs that they should be talking to, and then establishing an institutional lead. And then I would bring in angels and family offices with me right alongside. And the unique part is I convinced the largest SPV administrator in the country to hire me to be their customer. And so I was teaching everyone in the country about how to do SPVs, why it was valuable for the founders, why family offices and individuals could get great access. And I was doing that on a deal by deal basis. I ended up doing about what I would consider 35 deals that fit under what I is my thesis of investment, but completed about 60 SPVs in total, either helping founders consolidate their cap table and thinking through how to include strategic angels, but also going through that process. So for me, what that built was an interesting point of view. And that kind of has formed what I am today and how I see the world for Between the Coast Ventures, which is my established fund. I've deployed about $20 million in the past in that previous strategy. And for me, I've learned some things, some very important things in the way I see the world. One, uh, it's a very different conversation when you start to talk to people about investing in an asset class versus participating in a deal. Uh, and that's really been insightful for me. Uh, Two, who I choose to accept money from are my customers. And so I am very, very picky, or not picky, I should say, I'm very thoughtful about
Particular.
making sure that we see the world the same way, right?
Yeah.
Like that's more important, that we have aligned incentives. Like I don't want, I've taken the approach that I'd rather be the anti-salesperson than the salesperson. Hey, give me your money. No, no, this is a 10-year relationship. So I want to make sure you know what I'm going to do and how I think about it, and that I understand what you care about, and that what you care about outside of venture capital, because venture capital is a small piece of the pie when it comes to the capital markets compared to real estate, compared to private equity, compared to all of the other private credit and other asset classes that you're participating in. So that's kind of a little background. Before I did the startup, before I did venture, I did run mobile commerce for Overstock.com, a publicly traded e-commerce platform. I ran the full e-commerce division for the mobile, about $200 million division. Before that, I was doing M&A transactions where in blue collar industries like rail, trucking, marine transportation. Honestly, I kind of credit those M&A days to me learning how to talk to CEOs, how to endear myself to them, um, and also understand the end from the beginning. Like when I invest, I think about exiting. So that's probably a little too much just on the background, and maybe we can jump in more to the meat of like what is the what I'm seeing in venture right now and how it
Yeah,
might differ from.
yeah. Let's do that. But real quick, I recently spoke to an M&A uh, experienced person that turned venture capitalist.
Yeah.
And so what you just said is interesting in the context of what he said, because the M&A deal has always got an exit in mind, right?
Yeah.
And
Yeah.
so rather than, and I'm talking about him to just maybe articulate or expand a little bit on what you were saying, is that when he's looking at venture, he's not looking at it like the typical extreme venture company firm where they're funding as much as they can, flushing 90% and hoping they have a few unicorns. He's trying to invest in something that he sees a path to exit. Would you
Yeah.
say that that M&A experience suggests uh, is suggestive of your outlook on the world in that regard as well?
I would say I'm a little bit split there. I think my answer is I see M&A as who are the strategic potential acquirers if you go down a capital efficient route. So it's almost like a downside protection in is the way that I think about it. So um, my thesis really is focused on physical products with defensible IP, unique development heavy SaaS software where most VCs don't really want to dig into the technical side of things, or fintech operations. And so when you think about those verticals and I think about the M&A landscape, I already know who values what they're doing. And they may value it as a customer, but they also likely value it as a potential acquirer in this space. And so if you aren't overcapitalizing companies, like my fund's thesis is between the coast ventures, when you're not San Francisco, when you're not Boston, when you're not New York, and you come from a region where you only have 3 to 6 VCs in your region, you're not overcapitalizing the companies.
Yeah.
And when you're doing so, then it keeps the strategic M&A acquisition on the table while saying I'm still shooting for the venture upside. I only invest in a deal that I think has 20 to 100x upside potential. That's a minimum. Like that's what I'm shooting for. But I recognize that over 80% of the successes that I have will come from strategic acquisitions.
Yeah.
And so I do think about exit. It's less of the aspirational and more of a
A
call it
hedge.
a good middle path,
Yeah,
right?
yeah.
So if you're not overcapitalizing like those most of those regions where you're raising a reasonable $1 to $3 million venture round, and you're getting clear cut revenue, then yeah, the strategic acquisition is still on the table. And I love that strategy.
Yeah.
But it's not like if that was the case, that wouldn't justify the risk of venture. You're really still shooting for the two, unicorns that you can get in your portfolio. But I can now take my, baseball batting average from a 300, batting 300, where I'm good at my job to say, well, now I'm playing Moneyball where it's about getting on base, and that's actually what matters. And so when I do hit a home run, it compounds the returns. And
Yeah.
so I feel like it's the same way. I don't, it's not like a have to, but it's a thought process that just comes naturally to me of, okay, how would I connect to the right people? Even in the SPV administrator that I used to work for, I mean, technically I was a customer, but I was also an employee. I brought them a strategic acquisition, right? Like as an employee, I couldn't help it. Like it's just
It's
how
too
my
bad
mind.
they didn't do it, right?
Yeah, that's their own, that's the own situation. We can
Yeah,
talk about that.
yeah,
A good, healthy eight-figure exit would have been, great for that family and that privately owned business. So. So I don't say it's negative. I don't think about it as it's a have to. It's all about the upside. You invest in venture for the upside.
yeah,
You have to. But there are strategic exits that come quickly that on thinking through my LPs and what they value, I would be we'd be remiss to try to block an exit that gets a 4 to 5x multiple within, 2 to 4 years, right? Like that's great opportunity. So
yeah.
it gives cash back to the investors while also getting a great increasing the potential return of the fund. So
Yeah, put some numbers on the board, right?
yeah.
For sure.
Yeah.
So
Well,
you
I mean,
you
maybe
you
let's
want
take,
go ahead. Yeah. You wanted
I
to
was gonna say,
continue
maybe
on
we
that.
take the conversation, like, let me tell you how I see the world. And this will be three things that I see the world, and people may agree or disagree, but this is what I see. I see that there are a bunch of different models of venture. We talk about venture capital as if it's like all the same. And it's not. In fact, it couldn't be more different depending on what region you live in, and the way you think. And I kind of think about it this way of the San Francisco way of thinking is your job is to think of the most innovative new technology and adopt this technology and build out the product that is seeking out the right market. And you want the most talented technical individuals. And usually you raise somewhere between $3 to $10 million to go accomplish and build out the product the right way and find out where that market could fit. The New York model, typically, historically, you can tell me where I'm wrong here, Arthur, but the way I see it is actually that you don't build a product, you go build a board before you do anything else. And you get the most influential people on the board of this technology. And then through the board's connections, they open the door and you attract now capital and also now the opportunities. When you talk about the middle part of the country, this between this coast region, especially those regions that are seeing entrepreneurial success, the way that they view it is differently. The way they view it is I know how to get to customers. And in fact, usually they're coming from an industry that they already know very, very well. And they see why that industry is wrong. Not why doesn't hotel industry work this way, the way Airbnb decided to flip it on its head. They're saying, well, the piping of this banking industry is wrong. Why don't we change how this works? And they're raising their hand potentially inside the corporate environment or potentially add another startup technology and the opportunity to innovate within is not there. But they're like, you know what? I can't get over this. No one's listening to me, and they're all wrong, and I'm gonna go build it. And in fact, as they're doing that, they're oftentimes attracting customers
That are
without
going to
even
come with them,
knowing
right?
to,
Yeah.
right?
Yeah.
So they're validating
Yeah.
in the moment. And so the between the coast way is go get revenue or go get some form of momentum, whether that's other team members that recognize this value or strategic individuals that see it, and then they're getting to traction. And so they're getting to market initially. And those are the type of entrepreneurs I'm trying to attract in Between the Coast Ventures because the way that they do business is they've already validated the idea. And usually they find a way to get the technology to market. And then they're raising to backfill both hey, I need to grow the sales organization because it's founder-led sales, and I need to backfill the technology to improve it so that there's a true mode of differentiation. Sometimes they've already built that mode of differentiation in technology, which is crazy because many are able to do so by raising less than 500K to do it. So I like to come in when I have a product in market that can validate something that's scaling there and they're now at that point of inflection that we can go scale quickly. But I'm actually convincing them not to raise more. many VCs would come to that company and say, you already have 500K of revenue. You already have a million of revenue. Let's give you 10. Let's
Yeah,
give you,
10 million bucks to,
let's go scale this thing.
yeah.
And I'm like, no, 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 no. You've already bet on yourself. If you haven't raised that much money before,
Uh,
why not bet on yourself? This is better for you as the owner of the equity, but also for the company. Raise less at a lower valuation. And if you truly can go from a half a million to two or one to three, in that 18 to 24 months, we can skip a Series A, right? Or skip a seed plus, or
yeah.
like there's now most of these companies are doing two seed rounds right now and then raising a Series A. But you can skip that in between extra capital raise and choose to raise 10 million once you have $3 million of revenue. And that's a much different conversation when we talk to equity. I experienced this as the entrepreneur. I'm not trying to do me marketing. It's just after seeing 80 to 115 deals a month for the past 4.5 years, the people I would see, it was like way too early, didn't have any validation, but were raising at crazy valuations, like $12 million, which isn't crazy, but like, whereas I'd talk to a company doing 250,000 of revenue, raising at a five, at
Yeah.
a seven, and they're like, hey, we're growing at 10% a month, and I need another salesperson. And um, really interesting opportunities out there. So that's one of the things that I see geographically that I just don't see in other. Um, I don't see people talking about that much.
Yeah, I think uh, it's actually encouraging, right? That
Well,
these businesses exist. We know that people have found lots of ways of making money, and we know that people are in corporate environments where they see a gap and something could be fixed and could scale. So that's, we know that's happening. It's just interesting or encouraging to see that you've been able to find them. Uh, is it fair to ask to give us examples of the type of companies
yeah,
you're seeing?
yeah. So like I'll think of three, for example. So one was in the fintech space. They basically recognized, this was maybe less of a corporate spin out and more of a, hey, I built a startup. I was a top three employee of a successful company that sold for, $80 million, what, a success, right? But not venture huge success. And, he led all the technical side of things and was like, hey, I've been thinking about this for the last 5 years. I'm going to take this success. I'm going to put my own money in. I'm going to go build this because this is going to be bigger. This isn't just like I have an idea. I've been thinking about this idea for the past 5 years and now it's ready. Um, and it's in the fintech space. And they're actually basically teaming up credit unions with fintechs because normally those people compete for the same customers. And it's saying, we're going to embed an app store inside of the credit unions
Hmm.
rather than doing this. And we're going to integrate these two. This is actually one of the deals I have under term sheet right now for the fund, as I'm calling capital for it. This is what I would be using it for. And they already have integrated into every credit union is built on top of a financial core. And so they've got a core already signed up to say, yep, we already approve you. We're going to be able to distribute to our 16,000 credit unions that they can toggle in and out. And they already have about nine fintechs that are embedded into their application. So the credit unions can turn those applications on or off. And now they're just going through integration. So they're actually using the money to integrate to be able to distribute this, right? And that normally is for fintech, that would be like a company raising 10 to 15 million dollars to go build this, and they've done it for 1.5, right? A really capital efficient way, but they're at that point of inflection that once they hit go, you know, that could change the valuation to a $50 million valuation within the next 12 months. And that's where I feel it's really attractive. Now, valuations have gone up because they now have a signed contract with the core, and so you have to navigate those aspects of it. But
So
yeah,
is it the credit union using their app as a skin? Is that the idea?
it's embedded because it's in the core, which is built, all the credit unions are built on top of the core. It's already, they can just turn it on, it's embedded into their experience, where that now they are losing out on customers to these fintechs because they don't have
The user interface is not there.
The user interface is horrible and they don't
Yeah.
have features, right? And the big banks, really, it's the big banks, credit unions, and fintechs all competing for the same people. Big banks have everything. They have tech, they've got the branches, they've got everything. The credit unions have the relationships, the fintechs have the point solutions, but they don't want to do the banking and the credit cards and all the KYC AML. So they're able to rely now on the KYC AML, credit, everything that the credit unions have and do that. And ironically, what that does is most of these applications increase savings or increase movement of money, where the credit union benefits because there's increased savings or increased interchange. And so they've found this unique incentive where the fintechs are wasting all of their money on marketing dollars. Well, now this can be a performance-based only marketing dollars. So now they've given distribution. So it provides a really unique way to like innovate and provide distribution. So I really like that. Um, Another place I really like, and an example of a deal that's really capital efficient, is a lot of these companies that go through this little, call it a temporary lull, where I'll bring up one principle. I really like industries that are being rolled up by private equity. So I like software for those industries that are being rolled up. And the reason is as you roll up an industry, your willingness to adopt technology increases, but also the net return to you increases as well. Everyone knows that the dental space right now is being rolled up extensively. Well, that's a great opportunity that if you're investing in a hardware or a software technology that makes that practice more profitable, more efficient, increases marketing, AI marketing for dental, that's great. Cool. That's a great point solution. Probably not venture backable, but a great solution. You'll probably make a lot of money in that space. There's another company that they've recognized that these every health scan you do in the dental space of your face is actually it's tracking health and medical data. And now these dentists are actually technically liable for owning these things in a very non-HIPAA compliant industry. And so one of these
Yeah.
companies has said, we've integrated directly into the scanners. We take this scan. We actually have built a nationwide network of radiologists that will review this on behalf of you, the dentist, to protect you. And we have been able to positively identify cancer in 2% of your patients and potential cardiac arrest individuals in 1.7% of your patients. And in rare cases, immediate need for emergency help. And now they're going to the insurance providers who are now saying this now counts as preventative. And so it's flipping it on its head that now instead of it being a cost, a protection of the dentist,
Liability for the
which they
dentist.
were
Yeah.
still doing, they
Yeah.
still did 800,000 in revenue as a selling it as a liability protection to dentists.
Yeah.
Now the industry's flipping on its head and it's now the insurance are making it reimbursable where they will make now upwards of, insurance will pay 150, it'll cost them 75. So they'll make $75 per scan now by integrating this technology while protecting their space. And this company will benefit from not only having all of the compliance data, but as a SaaS revenue for this space. And so something shifted in the model, which will make it now that I think it can grow exceptionally. And I can invest in a deal doing 800,000, or they're now doing $1 million because they're growing about 15% a month at a $7 million valuation, right? Like that that I could do, which is when I talk to other people, they're like, that's crazy. And I'm like, yeah, I think they could do $3 million.
So I
dollars.
think others might be thinking what I'm thinking is like, how did you find that? Right?
You have to be the reality is you have to be able to talk to people like an entrepreneur and not be afraid to talk to them what's wrong with the business. So you always say, okay, well, what's wrong with that business? Well, they started with three people and it was really, really hard. And two of them ended up like going away. So they had too much of the cap table. So you just have to restructure and say, okay, if you're not in the day to day, you shouldn't own this much percent of the company. And as long as that's okay, the company looks great.
Yeah.
So you just navigate that. That's one thing. Usually I would say it's most of the time because as investors, we're all subject to emotions. And so what are we really drawn toward? We're actually drawn towards that momentum, right? That emotion is actually what actually draws us in is like, I feel it. I like know this is good. But actually, as an investor, it's very logical to say, no, 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 that's not always the right decision. I want to do that. Some of these individuals who I know I can trust, who I know will not overspend, who I know will like be responsible with the money, oftentimes are the worst individuals at creating FOMO or creating this fear of missing out. And so we as investors oftentimes fall subject to that FOMO. And when we do so, this is something that I kind of see and have observed over and over again. The largest narcissists in the world are the best at bringing up those emotions and enforcing that behavior. And you can see that through the successes of venture. But the type of founders that are capital efficient, that still have high aspirations, but can accomplish these things are a little bit more humble. Um,
Mm.
they're actually more willing to be replaced as CEOs. They're actually more willing to have a conversation and listen to advice on how you would build this. And so oftentimes they're hiding in plain sight because people won't listen to them,
Yeah.
uh,
They
ironically,
don't
because it's
have
like,
the gravitas of a hard driving founder, right?
well, they're also the, but I would say that's a different thing because I think one of the criteria is that I have is they have to have aspirations high enough to be able to go for that. Otherwise, it's not even a conversation. But many of these people have that, but they've just been so rejected by the capital markets because they're not falsifying the dream. They're
Right.
realists. They're
Yeah, right.
saying, well, we're figuring out sales, not, oh, yeah, we've got it figured it out.
Yeah.
This guy's growing at 15% a month and saying we're figuring out sales.
Yeah,
Like,
right.
like, like if you put that, those numbers behind somebody else, they're like, we're the best sales in the world, right?
Exactly.
So I think it's a lot about just being willing, and that comes back to what is money, right? Um, really if you're evaluating an emerging manager and if you're evaluating me, you should be asking yourselves three questions. This is like, does this person attract deal flow? Okay. Do they get things that I wouldn't see? And two is, what's their process of evaluating? But the third one is really, why would someone take their money over someone else's money? Because that's how you get into the best deals. Why? Like this guy, once he starts to publicly actually understand how he compares out there, he's going to have
People are going to
lots.
throw money at them.
They're
Yeah.
gonna throw money at that guy.
Yeah.
Like every dent strategic DSO, like there's so many people that should give this guy money. But like when it comes down to it, would he accept it? Well, I don't know if I want to give him money yet, right? But I'm getting because I'm willing to like to have these conversations, it gets me a first look at a company that has all the attributes that I would like and do I want to? And hopefully that type of relationship would make it that he would want to accept my money over others.
So
So
that example, Landon, is one that I would at another time want to drill down in because what's really interesting is how we came about the 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 idea of limiting the downside by helping the dentist thwart its liability. Like we don't
yeah.
have to talk about that now, but that's really interesting to me.
Yeah.
Uh, and uh, the other thing is that I think oftentimes in terms of data, like if he's got this data anonymized, nonetheless, it's super valuable if he can scale that data. Like
Yeah. Well,
that
that's
might
the
be,
upside potential of a
yeah,
deal like that, right?
yeah,
You feel comfortable because of the SaaS and you love it because of what you see is they actually could monetize the 2% cases they identify cancer to then bring them to the service care. They could actually make an affiliate revenue of which service care facilities they want to get there. And they could monetize all the data to the insurance companies or to the healthcare research facilities and pharmaceutical conversations. So
exactly.
you start to see these other areas while at the same time being like, would they get acquired strategically by the right dental group? Oh,
Yeah.
no brainer. Or the
Or an
CTV
insurance company.
or the manufacturer of the beam scanner that they've integrated into,
Right.
who's like, oh, we can now take our hardware business and make ourselves a software business. Wow. Like, so you
Yeah.
start to see all my mind just go, you have to see that without even thinking.
Yeah. Yeah. That's super interesting. I actually have had a recent scan in Park City It's fascinating, the technology, how precise it is. I mean, the picture is just right there, right? I'm sure the data's there behind all that, but the picture's there. Super
Yeah.
cool. So, what else? You got another one?
Uh, I think I'd rather talk a little bit about like some of the things
Yeah,
that I saw, like maybe historically what I've seen in the last 5 years, how it's changed.
let's do that.
I can give plenty more examples, like,
Yep.
but I think that it's important, like I said, to see the world the way I see it. I want to talk about that. I think that when we look back on COVID, what we saw was a huge amount of capital being deployed because of the cost of capital. But also, what we saw was a willingness to diversify geographically, where many of these coastal VCs, 80% of the money lives within New York and San Francisco. That's 80% of venture dollars. The first half of 2024, a third of the capital was allocated to three venture capital funds firms.
Yeah.
So what we're seeing since COVID is we saw people being willing to invest in other geographies. We saw diversification of the allocators. We saw more and more emerging managers. We saw lots of these trends, but it's changed. In fact, it's changed way more the opposite. So we're now seeing a much less willingness to invest between the coasts. They're willing to invest at the Series B stage, at the Series C stage. Anytime you have lots of revenue, they will come, right? But at the seed stage, you're not getting any coastal VCs to invest in Charlotte, in Atlanta, in Chicago, in Utah, in Houston, in Dallas, some in Austin and some in Miami. But that's just because they put somebody there. Um, so when you think about what's changing is you saw the money go right back where it was. You saw right back to convenience to say, no, I want to walk to my board meeting. I want to be there in person. This digital thing isn't great for me. Um, you saw also the capital being allocated to fewer and fewer parties. And 2024 is very interesting because I'm studying this. Like, I'm obsessed over VC. This is something that I'm putting my career under for the next 20 years. And so I'm preparing myself for allocating money, but also evaluating the future emerging managers long term. And what you saw in 2024 was the first time in the last 8 years that there were less small fund managers that were started than large fund managers. Those are large managers under over 150 million is what that line of threshold was. So normally you start to see more and more small people get started, and reality 2024 we saw that totally flip on its head in the first time for 8 years. And what that tells me is we're going to see the opposite of growth within venture. We're going to see venture growth in dollars, but the pain point is being exacerbated in these locations, all the geographies I mentioned, because the regional VCs tend to see what they want to see, and they tend to all invest in the same type of model. I'll use a couple examples. If I'm in Utah, where you and I are from Utah, typically the venture funds here are investing in SMB SaaS or enterprise SaaS, like because they're really good at the sales model. So if you fall under a model like a marketplace model or a very technically heavy industry, cybersecurity, none of those VCs are going to even recognize what to do with you. And they don't add any value, which means they're probably not going to invest, or they don't even understand it, which is even worse. Um, and the same thing happens when you go to Atlanta, right? If you're not true enterprise SaaS, they just don't even touch you because they don't understand typically the
So it's
regional VC.
siloed.
It's very siloed by geographical industry. The
Yeah.
way I built my model was bottoms up to say, where is the industry knowledge in these regions? So when I looked at Atlanta, for example, I look and I say, hey, every major financial institution has their second largest office in the financial services industry in Atlanta or Salt Lake City. So I'm investing in fintech in those regions. Why? Because there's already a deep industrial knowledge that's been there, and there's been successful exits in the fintech space in both of those regions which breeds the seeds that saying they know what to do. But ironically, there's no fintech focused fund in Utah. There's no fintech focused fund in Atlanta. There's like one that kind of pseudo does it in Atlanta. But those are areas of focus for me. So I build my model from the bottoms up. When I look at Utah, I like capital efficient SaaS and fintech. When I look in Atlanta, I look at fintech and I think of super development heavy data focused oriented industries. When I look at Dallas, I've got very strong real estate, so they might have some real estate technology there, but also very heavy data. I'm probably going to ignore the healthcare side, even though they're strong in healthcare. I just ignore the healthcare side because it's not an area of focus for me. Um, so
So
when
the
I
talent is embedded there because of the industry, but the VCs aren't focused on it because they are siloed in a
because
different industry.
each VC has to be a generalist, but inevitably where their success comes is becomes their industry of focus, right? Like that's just what happens. Or like in Dallas, for example, there's not that many VCs, so family offices function as the VCs, and so they only invest when it comes to real estate because that's all they know, right? And so they don't know how to value that. And Chicago's its own case study, but Chicago is surprisingly about 10 years behind where they should be. But that's just because the family offices didn't allocate to managers in their own region, and they allocated outside of the region, and so those VCs didn't invest in Chicago, and so they didn't build up their own ecosystem. So that's like a great example of if you want to build up your ecosystem, allocate to managers that are willing to invest in those regions.
Yeah,
Uh,
yeah.
So
So
I'm passionate about that. So the difference between my fund's thesis and these regional VCs, these regionals have to be generalists. Um, I like seeing innovation because I get to see the same companies going after the same problem, comparing Chicago to Utah to Texas. Because usually I see the same themes over and over, and I get to see how they think about their model. So that's really what I like being in that arbitrage. And the way that I'm able to be in that arbitrage is by having a deep network of individual angels that um, I help, right? I get them into deals that they know they want to do. That's comes from background. I ran a 700 person digital angel group with my syndicate. And I have the in-person angel group I run in Utah. Those are just ways in which I get to get a first look to see those opportunities.
is
And
it fair to say, and is there a trend that the general consensus is that the valuations in between the coast are just by definition lower than
Uh, depending, there are exceptions there, right? Proven entrepreneur that's exited before, you see very high valuations. And then I would also say it's it's industry too. So if you're doing an AI startup right now, doesn't matter if you're in New York or San Francisco or Texas, you're getting a little premium of investments. So like I'm gonna share one slide of my deck if that's all right.
yeah, of course.
Okay, so can you see this?
It's
So,
loading. I think it's loading.
all right,
Double click to enter full screen. Maybe it's me. Hold on.
I'll resume.
Yeah, no. For some reason it's not showing.
I'll stop and
Try it
I'll
again.
try again.
Yeah.
I'll try again. Here we go. All right.
Oh, here we go.
So, really, when I talk about this slide, it's like the VC market, like I said, 80% of the capital is here in these yellow regions. On average, the valuations are 32% higher in the gray areas, or 32% higher in the yellow areas.
Right.
Why is that? It usually has more to do with the fact that they're identifying the same industries, investing in usually the same entrepreneurs in those regions at the same time, therefore creating the higher valuations and just the inherent perception. So if I'm the founder that's able to create demand for my deal, then inherently I'm going to get higher valuations. But like we talked about, most of these companies are going to die. None of these companies are profitable. That's the venture model.
Right.
And so if they're not profitable, they're able to create this FOMO to say, hey, you need to give me money. I don't need to get your money. And so, yes, valuations are higher, but also it's about that industry. So if you catch the right wave of industry, um, one observation about that is uh, there's this thesis that I have called second wave investing. I really like this second wave. So this first wave of AI companies are all going to receive, over a third of venture dollars in 2024 were received in the AI company space. So what that means is all these companies are raising a ton of money and they're building up the demand for a market, but then they overcapitalize and fail. Maybe a better example to think through would be like the plant-based eggs or plant-based Beyond Meat, plant-based everything, super highly like overcapitalized beyond degree. Beyond Meat is a great company, let's be clear, but they raised too much money to establish what they were doing. And what were they using most of that money for? They had a great team, they were developing new products, so they probably had a lot of money in that. But a lot of that money was going towards marketing dollars to say, everyone should eat these
Right.
Beyond Meat burgers. Well, in reality, their market's probably 2 to 3% of the population. And if they weren't wasting their money trying to convince you and me to do it, but going after those that are already vegan and those the space, it would be a very healthy company in that space. And so what happens I see is there are oftentimes companies that come in right in the second wave that have figured that out and they're like, we're going to ignore selling fake burgers to Landon because he only eats real burgers. We're going to sell it to Sally, who it has allergies to these things, and we're going to find a way to get to market to her in a very capital efficient way because the way you get started is, and then you start to slowly incrementally grow. A company I've seen compete with a Just Egg, for example, they raised $1 million to reach $2 million in a plant-based egg, trying to raise $3 million to everything, and they struggled to raise. And why they struggle? They struggled because people look at this just price, and so because it sours the water for some of these cap in there. They're not going to be the biggest companies of the world, but it's a really interesting
So do you
thesis to
think,
think through.
yeah, thanks for doing that. Your connection was a little dicey. That might have helped. Do you think that in your next wave theory or whatever you want to call it, is it almost
Yeah,
always
yeah.
another company as
Yeah,
opposed to the
it can never come from within. The
yeah,
only other way I see is a private equity company buys it for pennies on the dollar and just
fixes it? Yeah, yeah, yeah.
they cut all the fat, entrepreneurial, hungry, do it with little philosophy. Their philosophy is usually like bring in well-established individual who's run a food company and is used to the corporate of this rocket while we're taping it together, which it's really you see.
Did we lose you?
Me.
That's okay. I think I heard you. We don't see the video. Can you hear me okay? It's all right. Hang in there for a minute. It'll fix itself probably. You're pixelated, but I can see you now.
Okay.
All right, so that second wave is super interesting. Uh, so let's see if we get a good connection here. I think we do now. Um, I was going to suggest we talk about, yeah, cut your video out for a second. Okay, that's better. Can
Yeah,
you
I
hear me?
left. Yeah, I left and came back. I'm hoping that will work.
Yeah, it'll probably work. Yep. All right, you look good now. All right, so we ended up on the second wave thing, and it's usually not the incumbent company, it's a new one.
Yep. Yeah. I think that's just these are just things I'm seeing, honestly. And, usually people try to very much state this is the answer. This is the way we'll invest. And I find it's someone that's had success and they're betting on themselves and they try to do it like that fintech opportunity or an entrepreneur that took a little bit longer, but they reached a point of inflection and now it's ready to scale, like that dental company where all of a sudden the model flipped and they're getting burst and they've revenue generator, or this kind of capital efficient way. Looks like I'm losing you again, but
Yeah,
that's the way I it. And capital, which is the fact that you have the upside potential, while still not taking away the transaction off, which is the best of both, I think.
yeah. So it was a little choppy there. Let's try maybe wrap it up by talking about the fund for a minute.
Yeah.
So just tell the folks, what you're looking for, the size of the fund, that sort of thing, and what your
Yeah.
time frame in raising is.
Yeah. So far where we stand is I have 3 deals under term sheet already. Um, one, one of those is the fintech deal. I have 2 others, one of which is has established revenue. Um, we're raising a $60 million fund. And we may end up cutting that to 40 just because the size is working out better, where some of these early deals will likely see greater traction. And so we'll utilize that. Right now we have $10 million in commitments. Um, we are doing a first close here in mid-March, and then at the end of March for those that are kind of struggling in that time frame. So we have one anchor doing about 5 million in that end of March timeframe, and one doing kind of middle of March. Um, when it comes to LPs, we're usually focused on the relationship. We want to know what you're doing outside of venture. We want to know how we can add value, where your background comes from. We're looking for LPs that are committing about somewhere between 1 and 10 million. That's because of the relationship. I sent out 421 K1s last year, and I'm doing those right now. And I've kind of decided to stop.
Yeah,
But
let's not do that again, right?
yeah, well, I mean, I'm still doing those for the historical deals.
Yeah,
Um, I didn't come from money. I didn't do these things. I had to prove no one would give me money as a venture investor, so I had to prove it on a deal by deal basis. And so to get started, I had to take investments from 10, 25K, 50K checks. That was the way I had to get it going. I learned how to be a fund manager from the hard knocks of that space.
that'll do it.
I
Landon, we met each other when you were at the tail end of that. Uh, and that heavy lifting will teach you a lot of things, there's no doubt about it. And good for you for paying attention because a lot of people wouldn't. Yeah.
Yeah, I also learned by being inside of a fund that I wasn't actually learning that much of how to run the fund and more just learning how to be like write reports in a fund, right? Like many of these people actually the spin out, whether it benefits me or others, like I don't care. I want more families to allocate to smaller funds. I think it's more aligned with your goals, to be honest. Many people think the spin out manager of a well-established fund has all this credibility, and I would say that's kind of true, but in reality, it's actually the person that understands how to vet a deal, like we talked about, how to track deal flow, how to build real relationships, how to support the entrepreneur when things are not going the greatest, and also know where to prioritize time. um, and open doors to actual customers. And so these are things that I really highly value. And I learned that inside of a firm, unless you're clear cut on the partner track, it's very difficult. And so, um, that's why I went and started doing deal by deal because the learning was so much greater. Um, I'm grateful for that pain of that process, actually. In 2022, the SPV administrator that I worked for went under, um, and it forced me to cover all the expenses for all of my SPVs. Um, and I didn't have any management fees in my SPVs because I was making a salary, so I didn't feel like that was appropriate.
Yeah.
And so, personally, I went through that, and that was for me what I needed to show myself, which was like, all right, when things go wrong, am I going to stay in this space? And if I hadn't shown that through that, that's kind of where I showed my true colors, I think, on demonstrating that this is where I live. And so, yeah, I'm excited for what this holds. Thank you for just being here and Arthur for your relationship to
Oh, for
talk
sure.
through venture.
Yeah. By the way, I remember that when you were going through that, it was a rough time, and you also did, people probably already figured out you're a hard worker, but man, there was some hell of a spreadsheet you put together of your alternatives, right? Of the SPV managers,
Yep.
that you could potentially shift to, and it helped others. Like all that work you did, you weren't keeping it to yourself. You shared it with others, right? Because everybody
Yeah.
else was feeling the pain too.
Yeah. Yeah. So, look, I believe that the future of fund managers, a lot of them are ecosystem builders. And so I'm emulating that. And I think you'll see that next wave over the next 5 years be that way. But the time to invest right now in some of these opportunities is now because so many people are running for the hills in venture. And it makes me so excited. We're getting rid of all the tourists
Yeah.
and that's a good time to invest. I'll put it that way.
Yeah. So it's not exactly the same thing, but Buffett says when the tide goes out, you're seeing who's not wearing a bathing suit, right? And so
Yep.
those people have to hide. Yeah.
Yeah.
Super. Well, this has been outstanding. Thank you. We're going to do it again, everybody, in more detail with the fund in a week. We'll send everybody the date and the details. It'll be 2:15 Eastern time, as we often do. And as I said, I'll make sure that everybody gets in touch directly. And please feel free to communicate directly with Landon. And I'm in New York right now, but we're coming back in a couple days, so we'll see you in Utah. So,
Sounds good.
yeah. Thank you, everybody. And thank you, as I always say, thank you for sharing with us. The only thing you can't make more of, and that's your time. Thank you,
Yeah.
Landon. Okay. Take
Appreciate
care.
it. Bye.
Bye-bye.